All right, so I'm going to give Tony Salgado a brief intro. Want to thank you so much for being here, Tony. Tony is a trained estate and tax planning accountant and life insurance advisor. Before founding AMS Wealth, Tony held various director positions within wealth advisory firms and began his career with PricewaterhouseCoopers, providing tax planning to high net worth individuals and business owners. Tony has provided insightful information on matters regarding to personal finance, tax, and estate planning to various media outlets such as the Financial Post, the Globe and Mail, advisor.ca, and has appeared as a guest on BNN Television and CBC Radio. Tony has tutored for the CPA Canada in-depth program and has been a facilitator for the CPA Ontario program. So quite the impressive resume. Really looking forward to your presentation. And again, thank you so much for being here.
Well, thank you for having me. And the resume, it's all lies. Don't believe anything.
I'm sure it's not.
Don't believe anything you read or
it's a lot of work to get those letters behind your name.
Yeah.
So
don't believe anything you hear on TV, right?
Awesome. Well, thanks so much.
Thanks for having me. It's 30 minutes that I have, and there's a ton of content. And so I'm going to try to make it as efficient as possible while still touching on some of the material that I think is relevant. So
perfect. And I just want to mention, if anyone has any questions, you can just stick them in the session chat. And probably towards the end, maybe you could answer questions if there's time.
Yeah, I would love to.
Awesome.
If there's time, happy to answer some questions. I try to make it interactive, but with the time we have,
for sure, 30 minutes is not a lot of time.
Here's my legal disclaimer. Also important for the lawyers.
Awesome.
And is that it for you, Rachel? Am I gonna?
That's it for me. I'm gonna sign off, and I'll be back towards the end. Thanks so much again for being here.
Thanks, Rachel. My core focus is tax on death and tax and insurance planning. And it's maybe some people understand how the two come together really nicely, and some people, this could be your first time listening to a session that compares or uses life insurance and tax in the same sentence, and why is that relevant, and what is it that I really do. So from my tax career, I jumped out, opened up my own brokerage, and so what we do is we partner with business owners, investors, to solve tax and estate problems using insurance strategies. So this could be a tax problem when you die, or this could be a tax problem while you're still alive. Basically, we look at strategies to solve these problems. So in Ontario, at the highest rate of tax, you're going to be looking at 53.5%. In Ontario, when you pass away as a business owner, you could be looking at significant layers of taxation, which you could be paying 70% tax when you pass away as a business owner if you have no advice or no help. You heard that number correctly. That is 70, and you must be thinking to yourself, how on earth did I pay 70% tax when I passed away? Maybe you're not going to care because you're not going to be here, but I'm sure that somebody will care. How do we get to 70% tax on death? Very simple. We have 3 stages of tax on death when you're a business owner. Stage number 1, you have your deemed disposition upon death. So like when you pass away, we pretend that you've sold everything at fair value. Stage number 2, your corporation actually has to sell stuff. So whether it be manufacturing equipment or investment assets, those have to be sold in order to pay for stage 1. And stage 3, you actually need to move the money outside of the corporation, stage 3. So these 3 layers of tax are really relevant for business owners and entrepreneurs and investors when a lot of their capital is tied inside corporations. So most of my clients have investments in real estate, and it's hard for real estate investors to do anything different. They know real estate, they understand it, and that's what's provided them their wealth. And I encourage real estate be continued as an investment, but add to the real estate portfolio. Don't get away from it, but just look at diversifying your assets. So that's what I tell people. Real estate's a great investment, but in today's environment, we look at significant appreciation on real estate properties all over Canada, and significant appreciation, even valuations on businesses are super high right now. So the high value leads to high tax. Throughout this session, we're going to be looking at a couple of really simple examples and some more complicated examples. With the 20 or so minutes I have left, I'm going to try to make the best use of our time. Very, very simple examples to start us off, and we'll build off of that. So a little bit of tax information for anyone that wants it. In tax, people think that you can sell a business and pay no tax. Not necessarily true. So you have access to what's called a capital gains exemption. This is only available if you sell shares, not assets. It is also only available to a certain limit and not beyond that limit. So you can see there the limits on the screen, about 892,000 for qualified small business corporation shares. Again, as a business owner, you need to sell the shares, not the assets. And farmers and fishermen, if we have anybody on the call that's in those industries, your exemption is about $1 million. So what does this mean? This means that if your shares qualify, you can actually sell up to $892,000 of value and pay no tax. We definitely don't have time to see whether or not shares qualify. So please speak to your advisors, your accountants, tax lawyers to see if your shares qualify. That is step one. Any value above and beyond these limits would be taxable. So tax on death, where is this found in the Act? So by the Act, I mean not like a physical drama act, but by the Income Tax Act. So in subsection 70 sub 5, for anyone who cares, we have a deemed disposition upon death. So basically, what does this mean? Everything that you have when you pass away is deemed or pretended to be sold. There's one main exception to this rule, the exception being if you leave stuff to your spouse. So if you have a wife, husband, partner, or a common law spouse, and you're going to be leaving assets to that spouse, those assets are generally not going to be taxable. But anytime you leave things to the next generation, we are going to be looking at tax. Can you believe that the biggest tax bill you'll ever pay is when you actually die? So kind of funny for the business I'm in. And I got to look at the humor because my specialty is death, taxes, and insurance. So tax on death in Canada is a deemed disposition, meaning that we're going to tax the value that has been appreciated. Very different from tax on death in the United States, where that is an estate tax on the value of your worldwide estate, not necessarily of your appreciated gains. So a little bit of a nuance there. Canada, we tax you on the appreciated value. In the United States, you're being taxed on your worldwide estate value. Different and important to know. What's happened with cottage valuations since COVID has started? Well, if you're in the market for a cottage, you're probably looking at paying a little bit more for that cottage. So we're going to look at a really simple example. Forget about the business owners, forget about all of these other things. Let's just look at somebody that has a cottage and a city home. What happens to those people? Is there any issue there? Some common myths I hear: life insurance is a scam, it doesn't work. Life insurance is only good when you die, and life insurance is costly. All of these myths are not necessarily true if you work with good advisors. Life insurance is an investment that can be exceptionally valuable to investors, whether you want to use it during your lifetime or leave it behind when you go. That's right, I said it. You can actually use life insurance during your life to enjoy some of those benefits while you're still alive. You don't necessarily need to die to use the benefits of insurance. And third, life insurance is costly. Well, it depends. What are we going to be using it for? So I can tell you that this morning I was looking at a file where the tax on death for the family was about $3 million, and the life insurance solution was going to cost about $1 million. So $1 million to pay for a $3 million problem. Is $1 million costly? Could be costly, but what are you relative to? So if you're relative to a $3 million problem, it's going to be an efficient solution. So always look at what you're trying to accomplish. What do I use insurance for in my business? I use it for 1, paying taxes on death. 2, to fund buyouts of family members that are not involved in the family-owned business. 3, for professionals or anyone that's retaining capital inside of a corporation and they don't really like paying 50% tax every single year. Can we build an investment portfolio inside insurance that is not taxable? And the answer is yes. And the last one, small business deductions that actually get ground when you have too much passive income inside your associated corporations. That's primarily what I use my insurance strategies for clients, business owners, entrepreneurs, and predominantly real estate investors that appreciate and understand how do you build capital assets without triggering too much tax leakage? You actually could borrow back from the asset, reinvest it in another asset. Primarily, you could do that with insurance in Canada as well. Very simple example. Let's start from the basics. The family cottage. So a lot of families believe that the cottage is extremely emotional and there's sentimental value to the cottage, but there are significant issues with dealing with this type of property. And this is the simple example. So if you have multiple kids, which kid gets the cottage during the summer? Which kid gets the cottage during the winter? That is a common problem. But the focus of my session is taxes and insurance. So the cottage could likely be taxable upon death. So who's paying for that tax on death of the cottage? That's right, the cottage is going to be subject to tax. Generally speaking, you're going to be using your principal residence exemption on the city home. So let me just touch on that for a second. The principal residence exemption is available to a family unit. The family unit, let's use husband, wife, son, daughter, they can elect, or you can elect, which property you want to use as your principal residence exemption. So if you have a Muskoka cottage, a Toronto home, look at what has appreciated more per year when you go to sell. So you actually need to do a calculation and see, does it make sense to use the principal residence exemption on the city home? I would say 8 out of 10 times, generally the Toronto appreciation is going to be more, and you're going to be using the principal residence on the Toronto home, which leads us to the cottage being taxable on death. Let's walk through an example. We have here some other strategies of like how to gift the cottage. So I'll tell you right away, most of my clients have the same kind of suggested approaches to deal with problems. And it's quite funny because I feel like they've spoken to each other before coming to see me. And the common thing I hear is, hey, you know what? If you're telling me the cottage is going to be taxable on death, I'll just give the cottage to my kids now. Well, not necessarily an accurate plan. So if you give the cottage now, you actually trigger the tax now. So typically you want to defer the tax and not trigger the tax today. So not necessarily the best strategy. Also, there's other problems that come with that, legal and significant compliance issues with how do you actually deal with the property if you gift it while you're still alive? Can you still use the property? Do you have access to it? And a whole bunch of other bottle of wax that you're going to open up if you gift the cottage today. Simple math, simple example. Let's say the Muskoka cottage, let's assume for argument's sake, it's worth $1 million. And let's say you bought it for 500. So 500K is your capital gain, your tax on death. I'm going to round it up and I'm going to say it's 150 grand. So you'll see it on the screen. It says 133,750. So let's assume it's 150. How do you solve for this problem? So you have this problem. How do you solve for this problem? This problem can be solved with what's called term to life insurance solution for $2,400 a year. That's right. So you have a $150,000 problem, and you're going to solve that problem with about, let's say, 1 to 2% of that problem paying per year. So this is a lifetime contract, and it will pay out when both husband and wife are gone. In this scenario, I've assumed that both of them are 60 years of age and in general good health. So is $2,400 a year expensive and costly? I don't think so if you look at what you get in terms of a return. The return is going to be a product that's going to pay out $150,000 to keep the cottage in the family so we don't have to pay for that out of our own pocket when mom and dad are gone. So that's kind of very high level, simple example when we look at people with multiple properties, and we're going to get into some more interesting cases as we move along. So a lot of my work is also focused on business owners, and sometimes business owners do not own the business themselves. So they have investors or partners that they've started the business with, and the business has grown in value tremendously. So what happens to the buyout when one partner passes away? Is there cash in order to do that buyout? I love it when I talk to people, lawyers, business owners, and they're like, don't worry, we have a signed shareholders agreement. And I know that the business is worth $10 million. And they say, well, there's a buy-sell provision in there, and we own it 50-50. And so if one of us either becomes disabled or dies, we have an agreement and the other person is going to buy us out. I said, that's great. An agreement is important and you need to have those buy sell provisions in there. But can I just ask, where is the cash going to come from? And then they just look at me and they're like, what do you mean? Well, you're going to execute the $5 million buyout, but where are the $5 million to buy it out? Oftentimes there's like significant values in businesses, but there isn't necessarily cash lying around. So where is the cash coming from? And so people kind of stop and say, well, that's a good point. We never thought about it. And it's this type of planning stuff, because business owners are so busy, and us professionals are so busy day to day, you don't really stop to think about this. So when I have calls with my clients and I tell them what I'm doing, what I'm up to, how my day is going, it's always very enlightening to them, and I always love to hear from them how their days are going. And you need to actually impart this kind of planning to business owners and clients, that to remind them that this stuff is important. This stuff can impact them. You have multiple people that actually have a vested interest in these type of businesses. Not only do we have the two business partners, we have the families of the respective two business partners. We have employees, suppliers, stakeholders. The stakeholders for a business are various. And so how do you actually have the cash there available when you need it to do something with it? The next case, I have one on the go right now, and these are so if you think the cottage example is like sentimental and could be complicated, take a look at a family-owned business. So we have Jim and Kelly. Jim is not involved in the family business. Kelly is strongly involved in the family business. And in Canada, we tie up a lot of our wealth in family, privately run businesses. And so what do I mean by that? I don't just mean as a general like GDP, I mean in family units. So if you have a business owner, entrepreneur, probably their wealth is 70 to 80% tied up in that business. And then they'll probably have 25% outside of that business. What happens when that piece of business, that piece of wealth, the 75% interest, is going to go to one, in this case, daughter, and not the son? How do we actually equalize the son? And we have this conversation of, can we create wealth using insurance for the non-active children? And so we could do that, it provided that there are certain parameters available in a tax efficient way. How do we do that? So let's look at an example here. So in this case, this is a real life file from a young 40-year-old female. And she wanted to, her objective was to use insurance as an investment. So this is a typical scenario. 40-year-old female has corporate or retained earnings. And if she were to invest this money in a bond, a mutual fund, these are all things that are taxable. Inside her corporation, the corporation is going to pay 50% tax every single year as she grows her wealth. So what other options are available for this individual? So here's an example where we opened up a portfolio inside an insurance contract, and we allow her to deposit $50K a year for 10 years for her retirement. So this is an example of using insurance for retirement planning. You'll see highlighted, by the time she's 65, we have doubled her investment, and we have multiple options on how to actually utilize it in retirement. So in retirement, the life insurance can actually be sold off, believe it or not. We can surrender it in tranches, and we would do that in a tax efficient way, or we can use leverage just like real estate. So take a look at a real estate investor that will buy multiple properties, leverage the property, and buy more property. Kind of the similar thing here. You build up an asset, don't pay tax, leverage the asset, and use the leverage for what you want to use it for. So kind of this is the wealth creator. This is you're using insurance to actually use it in your lifetime. You're not necessarily too concerned about what's left at the end. There's going to be plenty left at the end, but you actually want to create a retirement stream for yourself. And this is what we would do. Ideal age to do something like this, we typically like to do it below age 49. So anywhere between as young as you want to age 49. general rule of thumb, that's what we're going to be doing. All right, so I think I'm doing good for time. Try my best here. So we're going to do three case studies. So these are really interesting. This is where I really have my bread and butter. I really love these cases. It's unique. There's so many tax consequences, and estate planning is a lot of fun. So don't forget that. We're going to look at my favorite, wine and cheese, starting off. So wine and cheese, the real life story. I met with this 85-year-old. She had lost her husband, and she received preferred shares from the family-owned business. So preferred shares, they're a result of an estate freeze. Basically, she received a piece of paper when her husband passed away that says that she had an entitlement to $5 million. She never once saw one penny from this piece of paper, but the piece of paper said it was worth $5 million. Significant problems here. So there was no insurance planning in place after the estate freeze. The next generation had significant problems with one sibling running the business for all four of them. So can you imagine being like a sibling of four and no one is showing up to the family business but you, and everyone is participating in the profits? Kind of like a bad scenario, right? Like you don't need to be a lawyer and accountant to understand that if one person is working for four different families, probably not a good strategy. But the focus of this session is on that piece of paper that's worth about $5 million. How did that valuation come up? Well, at the time when they did the estate freeze, they had to do a business valuation. And so those preferred shares, there was no tax implication when the husband passed away. He left those shares to his wife. And so when we uncovered the fact that she was going to pass away and leave those preferred shares to the next generation, she was shocked to find out that the kids were probably going to have to pay about $2 million of cash to the CRA for these preferred shares. And she had this vision in her mind that outside of these preferred shares, the only thing she really had were like a RIF investment, and so which was going to be fully taxable when she were to pass away. So when I met with her, she thought that she was going to leave a $2 million investment portfolio in her RIF to four grandchildren, and each grandchild was going to get 500K, and that was it. That's what she wanted to happen. Unfortunately, little did she know that the $2 million was going to be fully taxed at 53%. So the $2 million was going to be less than $1 million. Further compounding the problem is somebody was going to have to come up with $2 million of cash for the preferred share valuation that was done. So not only was she not going to leave 500K for each grandchildren, her estate was actually short for the taxes on death that she was owing that no one had talked to her about. So multiple problems with this case study. Yes, tax on death is a problem, but then there's so many other consequences that happen with this. Moving on to the next one, Professional Corp. So he was a very sophisticated doctor and investor. This doctor works downtown Toronto, and he built other businesses outside of his primary practice, and his wife got involved in the business and all that. So they knew that they were going to have about a $4 million tax problem when they were to pass away. And they were in their mid 50s, and they came to me and we were talking, and they said, well, we understand that we have a $4 million tax problem upon death. And in order to pay for that using corporate money, it's going to be super tax inefficient. So we want to talk to you about corporate owned life insurance. The conversation was super sophisticated, and I probably have never met somebody that was so aware of the tax rules being a doctor. So I was curious. And then I ended up finding out that his dad was a partner at an accounting firm, and he grew up learning about a lot of these things. And so very, very sophisticated client. So what's the solution for this family? They need to get $4 million out tax efficiently. Well, it was going to cost about a quarter of that to get out the 4 million. So if you could look at the screen there, you'd see rough math, couple in their mid 50s. It's about $1 million to get four, and not doing anything crazy or anything like taking on significant investment risk, nothing like that. This is using a strategy that has a standard deviation of like about 1. Standard deviation for the finance people, how volatile is the investment? If you keep it about 1, it's no volatility at all. I can't say no volatility, but very little volatility over a 25-year period. So And a rule of thumb for anyone listening in, if you're doing estate planning, tax planning, insurance planning for families, for yourselves, here's a rule of thumb. People like rules of thumb. Couples in their mid 50s, take this with you. Your deposit should be about a third to a quarter of a return. So rule of thumb, if you're putting in 1 and you're getting 3-ish to 4, that's the rule of thumb. Okay, so I'll say that again. Couple in their mid 50s, assuming no significant health. And I should stop for 30 seconds on health. People are always surprised that health matters. Health does matter. So cancer, heart attack, stroke, diabetes, significant health things like that could also affect this planning. So that's important. So I'll say that again. Mid 50s, you're looking at 1 to 3, 1 to 4 ratio. Pretty good return on investment, mid 50s. And if you're looking at mid 60s, you're going to be looking at about 50% deposit to return ratio. So if I were to change this scenario, and I would say this couple was in their mid 60s as opposed to mid 50s, the deposits would be about 2 million to get me 4. So rules of thumb are always good. I always like the rules of thumb coming up. So I'm going to end in the last 2 minutes with the most sophisticated case: real estate developers, people that like debt, people that like leverage, people that find interest costs right now super low and attractive. So if you could borrow at 2 to 3% and earn 6 to 10%, would you do it? Again, not everyone is comfortable with debt. Not everyone is comfortable with carrying such leverage, but some people are. In my practice, I find the real estate investors, real estate developers, super comfortable with debt. In today's environment with ultra low interest rates, people are looking at this kind of like free money. Now, as an accountant, I always tell people there's no such thing as free money. No such thing exists. However, investors like that they can carry 2 to 3% interest. And so this strategy works for those people. The objective of this real estate family, they had lots of land, lots of building in Ontario's. They had a big tax problem upon death of about $9 million. So $9 million was a big tax problem upon death. And they had the next generation that was going to be fully invested into the family business. So they didn't have $9 million of cash sitting around, but they had a $9 million problem. And when we looked at depositing into an insurance product, it was going to be costly compared to the opportunity cost of that money. So if they were to deposit X amount of money into the insurance, they could not run their business because they needed to buy more land, more equipment, pay more employees. And this was the situation. So could we actually give the money back and run a solution? And we could. So we're not going to look at all of the math, but the math is there. And what happens is in these situations, we actually lend the money back. So money goes in day 1, day 2, the money comes back to the investor. The interest cost is 3-4%, and they carry the interest. They use the money to reinvest it into their own business, and we run the investment portfolio in the insurance product. Super efficient strategy. There are tax deductions available, a tax-free payout. This is for the investor, the real estate person that loves to use debt in their planning. This allows them to run multiple investments at the same time, a little bit more sophisticated strategy, but for the right investor and client, it works really, really well. What are we doing here? We're getting a tax deduction while they're depositing the money. We're giving the money back at current interest rates, and we're growing a tax-free insurance asset inside the business. That's what we're doing it for. And to nuts and bolts of this, what was the result of looking at this strategy? If they were to do nothing, it was going to cost the corporation about 12 million to get that 9. If we were to use a safe investment approach that doesn't move very much and it's not really fancy, it was going to cost that. And using the same kind of insurance with leveraging the money back, we're going to bring the cost down to 2.5. So I try to keep it on time. Time is valuable, and I really appreciate everyone that's logged on. My information is up there. I'm available for a question or two, and happy to be here. And I can see some light at the end of the tunnel with Ontario reopening, so that's good. I am available for questions. So if people want to ask any questions, I think we have a moderator on to take any questions.
Hi, Tony. Can you hear me okay?
Yep.
Hey, yeah, so I don't see any questions here yet, unfortunately. So anyone watching right now, if you want to pop a few questions in chat, that'd be great. But in the meantime, while we wait, Tony, I just wanted to ask, what's, I guess, the key takeaway that you want people to get from today's presentation?
Key takeaway is we live in a highly taxed society.
Mm-hmm.
And you can pay tax 50% or more during your lifetime and even when you pass away. So look at all of your insurance options to solve those tax problems.
Yeah. Okay, well, thanks. That was a really great presentation, and thanks for that takeaway there. Yeah, I'm still not seeing any questions here, so I think we can get wrapped up. So I just want to say thanks for presenting today. I know you presented at one of our events recently as well, so it's always great to have you. Definitely a great source of information. Thanks again, Tony.
Thank you.
Thanks. Bye.